a big day for us, and to celebrate 18 hours, 10 year of cutting-edge news coverage, which was led by innovation and led by unbiased aggression. To celebrate our 10th year anniversary, I have with me someone who's been a friend of the channel for nearly a decade now, Nimesh Shah of ICICI Prudential AMC. And Nimesh, some would argue that the fortunes of mutual fund industry and 18 hour tied together because they both have been quite extraordinary in the last 10 years. 18 hours as a channel and ICICI Pro as a AMC.
Yeah, I think, and you personally, I think you advanced the mutual fund proposition big time. So I thought this is the best time to talk to you also when you are celebrating your anniversary.
Well, celebration is something which we should always do on a daily basis because we are blessed to be born in a country like India. But along with good news, there is a little bit of anxiety which suddenly has come for debt funds. Now, the narrative for debt funds is not all that constructive, yeah. Nimesh. But just because there is a black sheep in this big mutual fund industry, especially in debt category, that does not make the entire herd black.
See, there is a lot of discussion on what is happening on the NBFC front. So I thought that it is best to come on your channel and clear it up. See, one basic thing is that the mutual fund structure, the legal structure of a mutual fund is very strong. You get what you see. So our portfolios are discussed and disclosed every month. So it is very clear where we have invested in each of the funds. Each fund goes as per the mandate. So investors only have to worry about that particular fund. I get it's a concern that the headlines come mutual fund have an issue. It does not mean that the entire mutual fund industry or the entire one entire fund house. There are specific schemes. There are specific schemes which have taken specific exposures. And if those exposures are a question mark, the problem is curtailed only to those exposures. You see a lot of stuff in the media that this particular mutual fund has got an issue. It is not that the whole company has got an issue. The one particular company would have got 20 different funds. Out of that 20 different funds, if one company, whether it was an ILFS or an Diwan, one has to see in which portfolio ILFS and Diwan are there and to what percentage they are there before getting worried about the overall mutual fund exposure. That's what I want. That's a very important part, that one should worry only about your portfolio. It is not necessary that if you have got a particular mutual fund house for portfolio, that means that every fund in that portfolio has got a question mark. It is only some funds which have that particular exposure to that percentage possible. Right? What is mutual fund? Mutual fund is all about diversification. So when you look at my credit, ICICI Prudential Credit Risk Fund, you are looking at 80 different scripts in that portfolio. So you are restricted, your every exposure is a percentage of that whole portfolio. Even if there is an issue, it would be restricted to 1.5 or 2% or whatever is the concentration in that portfolio. So diversification is what mutual fund is all about. There can be issues. Yeah.
No, I respect that, Nimesh, and diversification is something which we should emphasize again on a daily basis. But the general view is that mutual funds had taken a lot of risk in NBFC funding and loan against promoter or loan against shares. Debt schemes wanted better returns. The market was very competitive and risk management systems were compromised. Now whether it is one scheme, two scheme, 10 scheme or 15 schemes, well, some schemes have suffered.
So there are two topics that you are raising, and let's divide the topics into various parts. One is NBFC, one is loan against shares. So what is happening in NBFC? NBFC per se, it is a very healthy exposure that mutual funds have on NBFC. They had in September. Now the issues have started not today, they started in September 2018. Right? At that time, the NBFC exposure of mutual funds was around 3,70,000 to 3,80,000 crores. That was the range in which today also we have got 3,12,000 crores of NBFC exposure that mutual funds have with NBFC. If one particular NBFC has got an issue or two particular NBFCs have an issue, that does not mean the entire NBFC is in a bad state. So this, and when an NBFC, if there is a problem with an NBFC, the lenders to that NBFC are a problem. And why are we singling out mutual funds? Because mutual funds at least did mark to market. Say in a ILFS or a Diwan portfolio of 90,000 crores, mutual funds are only 5,000 crores. There are remaining 85,000 crores where I don't see any media coverage for the remaining part of the industry. What is happening to those exposures? Why mutual fund has come into the limelight? Because mutual fund recognize the losses upfront. Mutual funds have actually return of 75% of the portfolio in Diwan. That is why the whole media attention is towards mutual funds. But overall NBFC, so if there is a problem with any one particular NBFC, only that other NBFCs, it is business as usual. If you see the markets, forget what mutual funds have done. You look at the NBFC or the finance market per se. If we see overall, it is, what is the market indicating? Let's look at the debt market, look the way debt market looks at NBFC and the way equity markets are looking at NBFC. If you look at the equity markets, more the banking index or the financial services index is up from where it was in September 2000, which indicates there is no systemic issue, right? There are a lot of banks as well as NBFCs whose market cap is much higher than where it was in September. So they are the winners in this particular thing, and there are some NBFCs where market cap has gone lower than where it was September. So the market is indicating that there will be some winners, there will be some losers. Even in our case, even in mutual funds case or even in ICICI Prudential case, there have been some NBFCs where we have actually increased exposure since September, and there are some NBFCs where we would have reduced the exposure. So these are different kinds of NBFCs, and as any event happens in the market, there are some winners and some losers. This is as far as NBFC is concerned. So anything on NBFC, let's finish it first and then we come to pledge against shares. As far as we are concerned, we have not had any negative experience with any NBFC till date.
Okay. Given that risk and the fact that there is a general fear about how debt mutual funds have moved, do you think now one should not expect excellent returns from debt mutual funds? Because I'm just trying to understand here is that what will change because of these challenges which have come out. You know, a lot of mutual fund schemes were migrating outside AAA paper. They started taking risk because the idea was to generate 1 to 2% higher return than what the category was generating. Now obviously risk management will kick in. Are we in for very moderate, late single-digit returns from the mutual fund industry, especially on the debt side?
See, we have always, mutual funds are in various asset classes. One is equity, one is debt. So first we decide, if I were an investor, I would decide whether I want to be in the equity asset class or a debt asset class. Having decided that I want to be in debt, there are various kinds of funds, even in debt mutual funds. You can get into, if you want a very safe and very product. We have always had, there's nothing new. What I'm going to talk now is nothing new that we have installed now. Since last 10 years, when we moved away from only from AAA papers to AA and single papers, we all had to strengthen our risk departments considerably. Right, today when people ask me why don't we have issues in various NBFCs that have been in question mark, we don't have those because our risk department or a credit department which is separate from a fund managers. There are fund managers who decide which paper to take, but there is a central system which approves which credits can be taken and how much they can be taken. That is independent of the fund managers. There is a separate credit department. There are separate people who decide on which exposures to be taken and to what extent. So there is nothing new. Every fund has got a SID, scheme information document, which we would have registered with SEBI. It clearly said where will be in AAAs, where will be in AAs, where will be in single A's. So if you are into a single A segment, you are, and this is in fact the best time to answer your question in specifics. This is the best time in fact to invest in a credit risk fund because risk is priced properly. And since the credit spreads have increased, right, the return looks slightly lower. But suppose I have invested, I'll give you an example. Suppose I have invested in a paper at 100 rupees, say 1 year back. The credit spreads have increased, so the valuation decreases. The valuation has come to 98. But suppose I remain in that paper has been for 3 years, right? So after 2 years, I expect 100 to get back, so that 2 rupees will kick in later, right? So this is not the time to exit credit funds. This is a time, in fact, to enter credit funds, because the risk pricing is done very well.
Let's also talk about a style which, as a house, you follow. You know, Naren and his team, they like to always hunt where there is fear and avoid and sell where there is greed. Now, there are two large pockets of fear right now. One, you rightly pointed out, the debt market, especially the corporate debt fund schemes, and second, mid and small cap schemes. So for someone who says, look, you know, I don't care about risk or return, I care about absolute returns, which is a better proposition? Go for beaten down debt schemes or beaten down mid and small cap stocks and start a SIP there? And I know your answer would be start both, but if I'm insisting on one.
See, I don't think in India you can play contra on debt, right? I would not play, because we don't have a very active junk bond market that I'll play contra on debt. So when I am telling you to invest in credit risk fund today, I don't believe that I am asking you to play contra, only contra to the extent that the sentiment is negative. I would not take a contra bet on the debt side. Why? Because we are not a stress asset fund, we are a mutual fund, so we don't take contra bets. I am just saying that the credit, in my 26 years of professional career, I have never seen credit spreads been rightly priced. I always felt very bad that you are taking in risk but you are not getting the commensurate return. Today there is a clear difference between a AAA, AA and single A in the pricing, and that is a good pricing to take. I myself would have invested in the last 2 months into my credit risk funds, because I feel that they offer a good risk return. This one, as far as mid cap, small caps are concerned, this is a good time to come into. We had closed, as you know, we had closed our mid cap and small cap funds since a long time. Almost 2 years we had closed that. When we have opened up now, we are very comfortable with people coming in with a 2-year mandate, 2 to 3 year, if they want to start an SIP. It is a good time to start SIP in mid cap and small caps also. But remember, that is with risk, with enhanced risk. In credit risk fund, I believe that vis-a-vis a mid cap and small cap fund, if you want lesser risk and you are happy with the YTMs that are going on right now, where net of expenses, you should see the YTM and net out the expense. And if you are comfortable with that, what I was explaining you earlier also, that if you would have invested earlier also, and if you have not got the return that you have desired, because there are mark to market losses, if you stay for the full 3 years, because the duration is 2 to 3 years, the pricing bond which is valued at 98 will again get 100 rupees. So your pricing will again come right, and with a 3-year tenure, because taxation wise also you should come into debt funds only with a 3-year mandate. You should not come with a less than 3-year mandate. So if you are coming with a 3-year mandate, I think debt funds should be quite okay. And even if the 1-year return does not look good, that means the 3-year return, because it is the money is in the scheme itself. When I value a bond from 100 to 98, the returns look bad, but the money is in the scheme because the future returns are that much better. So credit risk fund is a good opportunity today, and if you want to take more risk and generate slightly more return, then mid caps also can be a good. I am invested in both, so that's the reply that I genuinely believe in. So what else do I give you? I give you what I believe in.
I've always appreciated this about you. Very few fund houses come out in the open on public forums. Not only the fund managers indicate what they are doing personally, they also come out with big calls. I mean, 2013, you were the first house who came out with the call to buy mid and small cap funds. And then the same fund house after 5 years came and said, sell mid and small cap funds. So I've always openly and privately appreciated this asset allocation call as a AMC you take. Now, Nimesh, we are talking about 10 years today. In last 10 years, in my book, 2 changes have happened. One, liquidity has been abundant, and inflation in last couple of years has somewhat globally become very benign. If one works with the assumption that in next 10 years, both liquidity and inflation challenges will not be big challenges, how does one go about investing from 2019 to 2029 or 2030? Because if you're thinking long term, you need to plan long term. And in 10 years, the macro dynamics will change.
Yeah. So one very interesting point that you have raised, one should look at the last 5 years and not the last 40 years. and this has been my favorite point, that where people somewhere believe that if you invest in equity, you will double the money in 5 years time, because that is what has happened. The doubling the money in 5 years time means a return of 15%, and people will give you examples of last 40 years that how it has happened earlier. But please remember, the very important point that you mentioned, Nikunj, is that earlier the inflation was very high. So with a 7% growth rate and a 7% inflation, the nominal growth rate of the country was 14%, and markets also gave around 14 to 15% over the last 40 years, 30 years, 20 years, 15 years. But if you see the last 5 years, right, when the inflation has been under control, the market returns over the last 5 years has been 9.5 to 10% only, right? So that is not a small return, because in a lower inflation environment, our interest rates will also be lower, and the returns from equity will also be that lower. So we can't have low inflation and high interest rates. We can't have low interest rates and very high equity returns. So a 10 to 11% return of a broad market is a good return to have over the next 5-10 years, because our inflation is also very much under control. If 2 to 3% is the inflation or 4% is the inflation, and you are getting equity returns of 10-11%, it is a good return if the market returns gives this kind of returns, and you add the alpha that mutual funds can give on that, and that's where that's a ballpoint figure. So we should not expect what happened in the last 40 years to happen in the next 5-10 years. That is why in that space again I am saying that interest rate, where our current YTM is at around 10.5 in a credit risk fund, you have to deduct expenses, and if that is the kind of return that one can make out of debt funds, they are good returns, they are not bad returns.
Return also needs to be viewed in terms of inflation, and something I want to tell our viewers, that inflation decides the way how risk-free return and how risky returns in the world would be calculated. Nimesh, this is just for our viewers so that they understand the concept we are trying to explain. Nimesh, I'm going to talk about.
I understand.
I'm going to talk about big trends. Now, the first big trend has been private banks have gained at the cost of PSU banks. The second big trend has been that Indians are consuming much more because the per capita is going higher. And the third big trend is that wherever government has vacated space, those sectors have done beautifully well. Which are the 2 or 3 trends which you think will remain constant, and which are 2 or 3 trends, or maybe one trend which you think would be an emerging trend and which will become like a large sector or trend to reckon with if we meet and celebrate 18 hours 20th anniversary? What is your view of the world, let's say if we are meeting after 10 years?
See, one very important trend that you have indicated, which is at a very slow rate. If you see the current issue also, I'll connect the current issue with the long-term trend that you are talking about. The current issue is also that the space from public sector bank to private sector bank. If you see the liability market share movement is only around 1 to 1.5%. The market share of private sector bank is only increasing by 1 and 1.5% every year. It is not. So today we have got 70% of the banking which is still with public sector and 30% is with private sector. That shift in liabilities is very slow, and it is only happening 1 to 1.5% a year. But the asset creating opportunities are very much with the private sector banks, because they have got that kind of infrastructure where especially the retail liabilities that they are creating, the retail assets that they can create are very good. So you have the current challenge with NBFCs where they are and not NBFCs growing. I don't think private sector has got a better time than this, that asset side capabilities are there. The current challenge for the country is also that when we were relating with the NBFC problem, that if the NBFCs don't get money, if the public sector banks are not disbursing, right, or are not able to create asset at that pace at which the private sector banks have got a very beautiful time where they can choose whom they want to give. They are not desperate to lend. They can choose whom they want to give. So that is a very secular trend that I see, that private sector bank, anybody who has got a great liability franchisee, anybody, whether it is NBFCs, are also good NBFCs who have got a good name and people will give them liabilities. So any financial intermediate, whether it is mutual funds, whether it is private sector banks, whether it is NBFC, who has got a great liability franchisee whom people trust any organization where people will trust with their money, the liabilities can flow in, and the asset opportunities are immense today, right? Because there is no relatively less competition on the asset side. We as lenders, where we as investors in debt markets or banks as lenders have got an opportunity to choose whom they want to lend to, and they can lend on their terms. That's a very good environment for private sector banks. So that's a one clear indication that I've got. The current market where we are, it is a clear stock pickers market, but within that also, if you look at a trend, we like some of the PSU utilities, right? PSU utilities are a very good space to be in because they have already got a 5-year, I would say that their 5-year plan is in place. When you look at some of the utilities, what is their profit very clearly, because the doctrine and the documents are in place, how their profitability will move over the next 3 to 5 years can clearly be seen. So select well-run public sector utility space is another space. I don't think this government is going anywhere from there. They are trying to strengthen the space, and it is another trend. Another thing that we like is pharma. It has not done well for us till now. We have bared the pain of pharma not doing well, but ultimately I believe that Indian pharma companies have got a great have got a good moat to be in the pharma space, because we can supply pharmaceuticals to the world, and we have those talent in India. Currently we are having some FDA issues, and all those are present in the pharma industry, but from a long term, the overall healthcare sector, which includes pharma, which includes local diagnostics, etc. The whole healthcare segment in India is a good segment to, if you were to ask me, two long-term trends. One would be the private sector banks, which have got a good liability franchisee, and another will be the pharma trend, the healthcare segment of India.
You know, it's so nice to have you, and we started with NBFCs, we've covered mega trends, we've talked about sectors you like, so you know, I always look forward to our interaction. You've been a big supporter of brand ET Now, and thank you for all your support and effort in last 10 years where we've reached. Well, it's largely because of friends like you who really supported the brand and the cause we stand for.
No, I would be very clear, and we genuinely mean it. I have not seen a bigger advocate of mutual funds, and if mutual fund have benefited great extent to the way ET Now has been persistent with us. They have questioned us at the right time, as you have done today, about whether we have taken too much risk with NBFCs, etc., etc. So good questioning, and keep us alert all the time. We are a very transparent industry. So and the quality that I see from ET Now, especially you, Nikunj, your whole team, the kind of depth with which ET Now goes into issues is something which is very worthwhile, and I'm very happy to be ET Now to go into issues in depth. Thank you.
Thank you very much.